Hi, I'm Jenny Brown. Welcome to this week's edition of MFB News. I hope I am finding you incredibly well, that you've had a really nice week and have been able to get out into that sunshine when it puts in a rare appearance. And for those people who are on summer holidays with their children, hang on in there, guys. I think we're almost halfway through. It's flying by. Now, in terms of what we've got for you this week, we're going to do our usual roundup of lender changes, what's been happening in terms of interest rates. There has been some positive news, actually. So again, really good to be back on a slightly more even footing in terms of the kind of tone of stuff we're delivering to you. We're also going to just talk about some changes in terms of lender criteria as well. Then we're going to be looking at EPCs. There's been some data that's been released which makes really interesting reading, which really kind of shows us the scale of challenge that landlords are facing in terms of their green improvements. And then finally, for those of you who are thinking about investing in the next couple of months or even years, 4 new investment zones have been announced by the government, which could present a really good investment opportunity for you guys. We're going to bring you up to speed on that as well. Okay, so it's been a relatively busy week. We had the Bank of England news last week in terms of base rate, where we saw base rate increase by 25 basis points. No great surprises there, actually. I think one member voted in terms of keeping things the same. A couple of people voted for more aggressive increases, but the majority went for the 0.25% increase, which I think we all knew was on the cards. So base rate now sitting at 5.25%, which was probably slightly more surprising for me, was the reaction from the capital markets, which was largely no reaction at all. So swap rates didn't really dip down any more than they do on any given day. What we like to see when base rate increases is the markets kind of react well to it. Is this whole kind of, yes, our monetary policy is being taken really seriously, and actually it's going to get inflation under control, and actually the longer term outlook for interest rates is kind of them staying flat and then coming down, which impacts the the way that it is priced on fixed rates on the wholesale markets, and that didn't really happen. So I don't know, I just sort of kind of thinking things through. Maybe the city just felt that actually the Bank of England should have been more aggressive in their approach. Maybe there's something else going on. But actually, how this is shaken out in terms of swap rates. So currently 2-year swap rates, 5.393. They were actually, just to give you some kind of balance about what's going on here, 1 month ago they were at 6.027. So they've actually dropped down by 0.7% over a month, but actually no great change in response to the base rate news last week. 5-year swap rates are at 4.731, and they were 5.206 1 month ago, so about 0.5% higher. So that's kind of really what happened there in terms of pricing. Now, what we have seen is a bunch of changes from the lenders, which I don't think is in reaction to anything about the base rate news and swap rates. I think it's lenders actually largely looking at their new business volumes and saying, actually, it's very quiet. I mean, it is quiet this time of year. This first few weeks of the summer holiday are always very quiet. Lenders are not immune to this either. And so what I think is probably happening is lenders are saying either, and we're prepared to take a cut on our margin, our profit, essentially, to drive down rates to try and attract some new business, some new lending applications, or maybe what they've done actually is overpriced in the first place. And because swap rates have been relatively static for a couple of weeks now, they felt more confident in terms of bringing down their mortgage rates. That's going to be why we've seen a bit of lender repricing downwards this week. So who has been doing this? So first up, Santander. So they've made reductions of up to 0.29%. So their pricing now on buy-to-let is from 5.73%. Now, Santander is a lender. They're a really good lender, very vanilla in terms of their offering. So individuals only, no limited companies, no multi-units, no HMOs. They can consider slightly unusual construction properties. If they would do it as a residential, there's a strong chance they'll do it as a buy-to-let, so things like eco homes, that kind of stuff. Maximum of 7 buy-to-lets in the background and 10 secured loans. So if you imagine that you've got a buy-to-let property where you originally took a mortgage and then you applied to the same lender for a further advance, that actually is represented as 2 separate loan accounts. That would class as 2 towards your 10 secured loans, not 1. So maximum of 10 secured loans, maximum of 7 buy-to-lets in the background. They do need you to have income of £25,000 a year. One of the things that they do, which is very good, is they have 6-month mortgage offers. Now, what we're saying to our clients a lot at the moment is we do genuinely believe the direction of travel for fixed rate pricing is going to be going downwards. However, as you would have seen if you watch this video frequently, the market is still super volatile. So actually it can take one bit of news and it sends swap rates back up again, and therefore fixed rate pricing will move up accordingly. So what we're saying to our clients is, look, actually you can apply for a mortgage now, you can book a rate at today's levels. However, if that lender were to drop their rates down between point of application and completion, then we can move you on to their new cheaper interest rate. And generally this doesn't come with a charge attached to it. Some lenders might charge you an administration fee, circa £150. What it essentially allows you to do is hedge your position, which I think in a time which is so uncertain, giving yourself some certainty is actually invaluable. So take a rate of today's money. Worst case scenario, that's what you're going to pay. Best case scenario, rates come down, you can move on to that. But actually, if they don't come down and things go in the other direction and go up, you know that you locked into the best rate you could possible, given the timing around you. So for lenders who have 6-month offers, this just affords you a larger window to apply in and then wait for things to move around before you have to commit and complete on the mortgage. Okay, so look, we've also seen the mortgage works make reductions, pretty sizable ones actually, so up to 0.95% reductions on their rates. So 1 and 2 year fixed rates with these guys are now from 4.99% and 5-year fixed rates from 5.14%. Now, the mortgage works are a truly spectacular lender. They have an offering which fits a large number of landlords. So they have their vanilla offering, so landlords with less than 10 buy-to-let properties in their personal names, which is kind of like the, if it were the cheapest range, but then have a larger portfolio product for landlords with 10 or greater than 10 buy-to-lets. And they also have a limited company offering as well. So if you imagine if their rates are sort of 2-year fixed from 4.99, that's going to be for the very first category, the landlords with the less than 10 buy-to-lets in their own name rather than anything else. But really, really solid from these guys. We've also seen the Coventry reduce some of their rates and actually increase others. So it was a bit of a mixed bag, but their pricing there now is from 5.8%. I love the Coventry actually, I have to say. I can't really tell you why, I just find them really nice to deal with. I find them consistent. They have an offering, it's very black and white, which really allows for certainty for borrowers. And actually, you know, they're always trying to do better. They're very, very good. So these guys, individual names only, no limited companies, no racy properties, maximum of 10 buy-to-lets in the background. One of the things they do when they're looking at your 10 property exposure is they ignore anything in a limited company, which most lenders don't. So just worth knowing that as well. And the other thing that they have is a no minimum income requirement. So really lovely offering from Coventry, and great to see at least some of their rates have come down. Now we've seen Lendinvest reduce their pricing. That's the second time in a couple of weeks. Dare I say, I suspect that's linked to business volumes. Pricing there now from 4.54%, but please watch the arrangement fees. These are a specialist lender. They're going to be reliant on the capital markets. So if you think about the profit margins, or the margins the lenders need to add above cost of funds, circa 2 to 2.5%. If the 5-year swaps are at 4.7%, then in the round, including all your fees, lenders need to be charging sort of between 6.7 and 7.2. So anything that sounds really low is going to come with a large fee at the moment. Now Lendinvest, again, specialist lender. So they're good at limited company applications. They can take on HMOs, multi-units, no minimum income requirement, no maximum number of properties in the background. Also, very, very good at bridging finance, incidentally. Now, lastly, we've seen Paragon reduce their limited edition rates. Now, these are now from 5.6%, but again, you need to watch the arrangement fees. Word on the street is we may see a reprice from Paragon on Thursday, but I don't have details of that yet. But the good news is, when a specialist lender, such as Paragon, reprice, other lenders do tend to pay a lot of attention. So you might see the start of some movement on the back of any reductions they may make later on this week. But the limited edition rates they've had are very good. Paragon, I mean, you know, if you watch this frequently, you'll know I'm a huge fan of Paragons. We have the most wonderful relationship with them and their underwriters. We find them absolutely brilliant to deal with. They really are experts at landlords. No maximum number of properties in the background, no £25,000 income requirement. They can do layered companies, day one remortgages. They're really, really fantastic. Multi-units of up to 20 self-contained units, HMOs with up to 20 bedrooms. So some really, really lumpy properties on buy-to-let rates. It's incredible. And that kind of is it in terms of lender pricing this week. Like I say, the first couple of weeks of the summer holidays are always a very quiet time in the sort of mortgage market. So I'm not surprised that a couple of lenders have been kind of re-looking at their pricing and trying to drive things down a bit. I suspect we may see a bit more repricing over the next week, but obviously we'll report back on that next time. Okay, now just quickly, a couple of bits of lender criteria changes that I wanted to share with you. So first of all, we've seen Precise Mortgages, increase the rental calculation that they apply to your background portfolio. So when they're lending to landlords, as well as underwriting the property which they're lending on and applying a rental calculation on that. They're also going to apply one to the background portfolio as well. And this is standard across all lenders, particularly when they're underwriting portfolio landlords, so landlords with four or more distinct mortgage buy-to-let properties. Now what they've done is they've increased the rental calculation. So now it needs to be 125% coverage, assuming an interest rate of 5.7%. It used to be 5%. So essentially the portfolio in the background needs to meet a more onerous rental calculation. Now Precise are not the first lender to have changed this calculation. We've seen different lenders doing the same thing over the last few months, but these are the most recent lenders to do so. The other piece of criteria change we've seen last week, which was one I was really glad to see actually, was that Interbay have reduced their minimum loan amount from £2 million to £500,000. Now they've also incidentally reduced their interest rates, but they've then increased the arrangement fee, so it's kind of like an almost neutral kind of change. But I think the minimum loan being reduced is a really big one. So Interbay as a lender are a commercial lender that does a bit of buy-to-let. So these guys can help you with commercial investment, commercial owner-occupier, semi-commercial, but also they can deal with more lumpy buy-to-let, so really large HMOs, really large blocks of flats. They can also help you with portfolio loans, so one loan secured against multiple properties. They're also great at things like complicated company structures, and there's a whole world of things they can help with. So actually, when they had increased their minimum loan to £2 million, which was just a couple of months ago, and they really did that to slow down business volumes, so they're getting absolutely swamped with new business. Unfortunately, then precluded a load of our clients who we would have ordinarily wanted to place with them. So the fact they've dropped that down is absolutely fantastic news. Okay, moving on to EPCs, which I'm sure is a subject which starts to make a lot of us feel really frustrated just in terms of the uncertainty around the changes, the proposed dates and all that kind of stuff. However, Savills have commissioned some research, and what they have found is that actually the number of properties requiring upgrades to get them to a C or above is 2.9 million private rented homes, which is like half of the UK private rental sector. So 2.9 million private rented homes are going to require works to upgrade them. Now, what they went on to say, and this is really interesting, is that 51% of the 728,138 EPC certificates which were issued for homes in the private rented sector in 2021 and 2022 remain below EPC level C, which is down 73% incidentally from the same survey which was done in 2016 to 2017. So we have actually, it looks like, really improved the energy efficiency of the UK private rental sector. There is still 2.9 million private rented homes which would not currently meet the proposed EPC rating of C or above. Now, some 71% of homes built before 1950 were granted an EPC below C in 2021 to 2022, whereas just 12% of private rented sector property built post-1995 require improvements, which could be why we've seen some landlords opting to look at more modern properties when they're considering investing. Now this is the bit that I think you'll be really interested in. So Savills' analysis of EPC recommendations reveals that the cost of fully upgrading properties to a maximum EPC C ranges from $8,807 for a property that is currently a D rating, up to $27,366 for a property which is currently rated at a G. Now, I think this brings into question lots of things. So first of all, exemption limits. I know that the number of £10,000 has been kicked around. How likely that is to kind of come to fruition, I don't know. But obviously, if you're faced with a bill of £27,000, and obviously a £10,000 cap would be quite welcome. But actually, there are going to be a chunk of people who are still going to end up spending nearly £10,000 to get their properties up to par. Now, the other thing this report went into, which I won't kind of read out to you, was how landlords are going to start funding the cost of this. Now, when we were speaking to our clients, a lot of them are saying that, do you know what, I'm going to need to do some improvements to the property. I know I'm going to have to spend some money on this, but at the moment, I just don't feel like I'm ready to do that because I don't fully understand the details of the proposed requirements of me. So a lot of people are kind of just holding things on. Now, if you're taking a 5-year fixed rate today, there is every strong chance that actually your 5-year fixed period is going to take you beyond the changes coming into play for EPC minimum of C. So what we're sort of hoping and encouraging our landlords to do is just consider that actually if your property doesn't have an EPC rating of C at the moment and you're going to need to make some work, how are you actually going to pay for this? And most landlords don't really want to have to find £10,000 out of their own savings to cover these costs. Most of them would prefer to borrow the money. So if you are remortgaging at the moment, you're able to, it might just be worth casting your mind forward a bit, thinking about the EPC changes and just really considering how you're going to fund any improvements that you're going to need to make, and whether you want to just increase your mortgage slightly to cover the cost of those. Okay, now finally, for those of you who might be thinking about investing in the next few months or years, an interesting announcement was made which really piqued my interest. So the government has essentially announced 4 new investment zones. And these are going to be areas in the UK where they're going to be investing lots and lots of money to build not just new homes, but also to drive up employment and improving infrastructure and that kind of stuff. Now, whenever you get an area where this happens, invariably people move there. It increases the number of people residing in that area and the desirability to live there, and it increases demand for private rental stock. So this is where our kind of minds are going with this. So first of all, there's going to be 250,000 new homes built in Cambridge. That's the kind of big one in terms of the scale of the houses that are going to be built. Now also, there's going to be a Docklands version 2.0 in East London for 65,000 new homes across multiple sites, including Thamesmead, Beckton and Silvertown. Now, the Department for Levelling Up Housing and Communities said that beautiful, well-connected homes and new landscape parkland will be integral to the vision. We'll look at how we can ensure better transport connections from east to west to crowd in local and private investment, and to build the best evidence on how and whether the government will invest in the future. So essentially what they're doing here is saying that they're going to build lots and lots of houses in the east of London, but also what's going to be pivotal with that is the transport connections between east and west. So if you're thinking about investing, at the moment it's probably just worth bearing in mind the kind of infrastructure changes that could come into play on the back of this. Now, the third place is that the government are saying that in central Leeds, they're going to work with partners to regenerate the city centre and explore how a West Yorkshire mass transit system could open up the city to many more workers across its burgeoning financial, digital and legal sectors. The government has already allocated £40 million to the West Yorkshire Combined Authority to support the development of the mass transit system, and of what it pledges will be a greener, quicker and more reliable option of travel. So essentially, I think, in terms of investment opportunities, obviously central Leeds would be one thing, but actually if you start considering the kind of outlying towns where maybe the connections into Leeds where people go to work have been very sort of cumbersome and difficult to use, actually that makes commuting in a lot easier, so it's just worth kind of keeping your mind there. And then finally, the government has said that it's going to work with local partners in Bury-in-Furness to help make it the new powerhouse of the north, extending beyond its current boundaries with thousands of new homes and space for new businesses to benefit from the scientific and technical expertise already clustered there. So Bury-in-Furness is in Cumbria. There's a huge power station up there. There's a lot of kind of scientific roles already in existence, and they're obviously looking to capitalise on this. Now, whenever you kind of bring a load of employment into an area, what tends to follow is people needing to come and move there. Not everyone wants to buy immediately. It could drive up the demand for rental properties. So Bury-in-Furness is another place to keep your eye on. And that's us wrapping it up for this week. I hope you found that helpful, but as always, if you have any questions, please do give us a ring, 0345 345 6788. I hope to be back in front of you same time next week with some more lovely, shiny mortgage rates. We're also expecting the ONS inflation data, so that's going to be kind of doing the rounds. We'll be discussing that as well. But in the meantime, just look, have a really good week, have a great weekend, and I'll see you same time next week.